What's up, YouTube? I'm Debt-Free Joel. On today's video, we're going to talk about the Inflation Reduction Act, a specific provision in there that increases a tax rate of 1% on all stock buybacks. What does that mean for your portfolio? Stay tuned. If you like these type of videos, cool. Click the like and subscribe button, and let's get to it. So Congress just passed the Inflation Reduction Act, and there's a ton of things that are going to be in there. Whether or not it's actually going to reduce inflation is a whole nother story. But there is one key provision in there that you as an investor should be aware about. So there's going to be a 1% tax on stock buybacks. So what are stock buybacks? Stock buybacks is when a company has extra cash on hand, and what they do is exactly what the name implies. They buy back the shares that are outstanding, or at least part of it, so that they can boost their stock price. Now here's the logic behind it. So all companies, at least publicly traded companies, have a lot of shares that are outstanding, right? Shares that they distribute to the public. So when they buy back shares, it artificially boosts the price of the stock that you own. Think about it this way, right? When you're looking at look like CNBC, Bloomberg, Fox Business, whatever it is, when you see ticker symbols, those are price per share. Well, if I reduce the denominator, the shares outstanding, the price automatically increases. This has actually been going on for a while, and I believe it hit a record in 2021 where almost $900 billion worth of stock buybacks occurred. So why are companies doing this? It's one way for them to not necessarily be taxed on the dividends and things like that, but it's a way for them to pump up their prices in terms of their stocks. So what does the 1% tax actually mean? The 1% actually means is that a company is going to have to pay a 1% tax on every time that they actually go about doing a stock buyback, for example. So what does that mean for you as an investor? Two different things. Number one, this goes into effect as of 1/1/2023, and as of the recording of this video, which is August 2020, that means that companies have about 4 months to do any type of stock repurchases that they want or stock buybacks that they want before the tax kicks in. So that may mean that there are companies that you own right now in your portfolio that are automatically going to get boosted up because they're going to try to rush these stock buybacks in before the end of the year, right? Before the actual tax increases. Or the tax kicks in, I should say. So that's the first thing. You may see your companies do stock buybacks. The second is that as of the top of the year, when the actual tax kicks in, you may see companies steer away from stock buybacks and actually do stock dividends. So a dividend is basically when a company gives you some money back per share that you own. It doesn't really create any huge profit for you though, right? What most folks don't understand is when a company pays you dividends, the stock price falls proportionally to the dividends, so you don't actually get any new value. What happens is that the value that you do get occurs over time when you reinvest those dividends into the actual stock, or you could just take the cash out and put it in your pocket. But most folks reinvest their dividends. So you may see actual companies doing this more because of the 1% tax. Now, a lot of people are debating this about whether or not this is going to have a huge effect on stock buybacks, specifically because when you talk about publicly traded companies, those executives are usually not paid excessively high salaries. You see, what they're paid are stock options, right? When they're paid stock options, that means that they have an option to exercise the stock later on in life and convert it to shares. Well, this may actually be a wash over time. So on one hand, you have a company that's repurchasing their stocks, right? Which is going to reduce the shares outstanding. And on the other hand, that same company is paying stock executives stock options, which is going to allow them to increase their shares outstanding. So it may wash out over time. But for you as the investor, the most important thing to consider is that for the next 4 months, if you own shares in a stock that are going to be repurchased or they're going to actually be bought back, you're going to see your stock price increase. And then as of next year, there's a very good chance that your company that you own is not going to want to do the stock repurchases again or the buybacks, specifically because they don't want to incur the tax, which means you may get actual dividends. Got it? Good. If you like these type of videos, cool. Click the like and subscribe button. Feel free to follow me on Instagram. It's @DebtFreeJoel. It's the same name as YouTube. We put a ton of information on there about saving, about investing, and most importantly, about being charitable. Until next time, keep your money up.